Most investors start their journey with one big question. Should you pick individual stocks or should you put your money into index funds? And while the debate has been going on for decades, the truth behind it is much simpler than most people think. Stock picking is exciting. It feels powerful. You get to choose specific companies you believe in, analyze charts, dig through earnings reports, follow trends, and try to find the next big winner before everyone else does. It makes investing feel like a skill game where the smartest person wins. But here's the part most people don't know. Stock picking is extremely hard to do well consistently. To beat the market, you have to outsmart millions of other investors, including hedge funds, institutions, analysts, and algorithmic trading systems. These players have more data, more time, and more experience than any average investor could ever match. And even with all those advantages, the majority of professional money managers still fail to outperform the market over the long run. That means if experts with decades of training struggle to beat the market, what chance does a regular investor realistically have? Now compare that to index funds. Index funds don't try to beat the market, they simply match it. Instead of betting on individual companies, you're buying a slice of hundreds or even thousands of them at once, typically through broad market indexes like the S&P 500. And because the overall economy tends to grow over time, index fund investors naturally grow with it. No predictions, no panic decisions, just long-term participation in the entire market. One of the biggest advantages of index funds is diversification. If you pick a single stock and that company crashes, your portfolio takes the hit directly. If an index fund holds 500 companies and one of them collapses, the impact is barely noticeable. Diversification protects you from the random surprises that happen in business: scandals, bad earnings, leadership failures, market downturns, or sudden competition. You're not relying on one company's success. You're relying on the growth of the entire market. Another major difference is emotional behavior. Stock pickers often get caught in the cycle of fear and greed. They chase hype, panic during dips, sell too early, or hold too long. In fact, emotional decisions destroy more wealth than bad investments ever will. Index fund investors, on the other hand, have a simple strategy: invest regularly, ignore the noise, and let time and compounding do the work. This steady, disciplined approach allows their wealth to grow even in the face of short-term market volatility. Cost is also a huge factor. Index funds have extremely low fees because they don't pay teams of analysts to pick stocks. Meanwhile, many stock pickers, even individuals, lose money without realizing it through frequent trading, taxes, and high-risk bets that don't pay off. Over decades, these differences can add up to hundreds of thousands of dollars. But does that mean stock picking is always bad? Not necessarily. Some people genuinely enjoy researching companies, analyzing industries, and placing strategic bets. Others want to own specific companies because they believe in their mission, their founder, or their long-term potential. For those investors, stock picking can be rewarding, but it should still be done with caution, discipline, and a willingness to accept losses. The real truth is this: index funds are the most reliable and stress-free way for the average person to build long-term wealth. They offer diversification, stability, low fees, and consistent returns that outperform the majority of active investors. Stock picking can work, but it requires time, knowledge, emotional control, and the ability to handle volatility without making destructive decisions. In the end, the choice comes down to your goals and your personality. If you want steady, predictable growth with minimal effort, index funds are the answer. If you enjoy the challenge, the research, and the thrill, and you understand the risks, then stock picking can be a part of your strategy. Just remember, you don't have to pick one or the other. Many investors use both: index funds for their foundation and individual stocks for their high-risk, high-potential side bets. But for most people, most of the time, the simplest advice still holds true. Don't try to beat the market, just join it.